Good morning. Michael Saylor, as Michael Saylor tends to do, made some big announcements through strategy, what used to be called MicroStrategy, about two new strategies that he was introducing for people to participate in the Bitcoin economy. And both of these are targeting a part of the economy, which is a $300 trillion part of the global economy called fixed income. Now, I think it's worth talking about this stuff, but this stuff gets very, very complicated very, very quickly. So I thought maybe one way to approach this would be actually to start with something a lot simpler. Um, and so I want to talk about the most sort of fundamental thing that I think people should be thinking about, that I think about when it comes to investing, when it comes to money, which ties into all of the things that Saylor talks about, how fiat is dissolving, that inflation basically means that if you're holding cash, you're constantly losing money, and then ties into the strategies that he's providing around fixed income, and that maybe also sheds some light onto the importance of fixed income. But I think this also touches onto something else, which is how important it is to be invested. Really, I think that's, if there's one message that Saylor is communicating to the entire world, it's that you cannot hold cash, but that you absolutely want to be saving. So what do? And the other thing this ties into is there's this overall sense that I have, and I've spoken about a bunch of times, that people have a sense of desperation, that they need to get rich quick or they're never going to be able to get rich at all. And that if you don't get rich, then your life is not your own. You can't make the decisions that you want to make, you can't have the sense of security that you want to have, and you can't give your loved ones what you would like to give them. So I'd like to start there, examining that idea. And for this, what's nice about this is I think we can start with a very, very simple chart instead of like the very, very complex analysis that would be necessary to actually do a deep dive into strategies, new STRF and STRK offerings. Okay, so there's this basic idea that I shouldn't save money. A lot of people take on debt or they struggle to live within their means. Part of it is because, let's say I just managed to save just a few $1,000s. What difference does that make? And so I'd like to look at what difference that can make on sort of the most basic, most traditional level. If you're able to save over the course of a few years, just a few $1,000s a year, that can quickly accumulate. And the fact that it's accumulating just as principal is one thing, but what's more important is how every single dollar, every single month that ticks over can accumulate more. So I want to imagine a scenario. Imagine yourself when you were young, or imagine maybe you have kids. You don't need to imagine, maybe you have kids. And you've managed to squirrel away $100,000. Okay? Now, you could keep this $100,000 in cash, and that would be very, very bad. You would very quickly lose the value through inflation, year after year, month after month, of that $100,000. But even if you put it into a bank account which tracks inflation, which don't really exist anymore, you'd still only be left with $100,000, and it might be difficult to think how $100,000 can be life-changing money for you or for anyone. But then let's look at this number. This number over here is 1.06. And what it represents is, over the last 100 years, on average, with some variability, but on average, for 100 years, year after year, the United States stock market, the S&P 500, has provided a return, a yield, of 6% per year. Okay, so Now, let's go back to the scenario where you're a kid and someone puts $100,000 into the S&P 500 for you. Well, after 10 years, that doesn't look that different, right? It's okay, so it's grown, but it's only grown to 180,000. Now, one really important thing to note. This 6% is after inflation, right? So the actual S&P returns something like 10%, between 8 and 10% a year. But when you take into account inflation, you have to beat inflation. And so over 100 years, it's beating inflation by 6%. So we can hold the dollars constant. This is, if this is 2025, and this then 10 years later would be 2035, then this is $179,000 in 2025 dollars. And in 2035, you've actually got a lot more than that. In fact, how much more than that you would have? Well, probably something like $226,000, which is what $180,000 would be worth after inflation. Anyway, after 10 years, things don't look all that impressive. You've almost doubled your money, but it's still not life-changing. But now, let's think about your kid, or you, if someone had put money when you were born, right? And now you need to go to college. Well, after another 10 years, it's more than doubled, right? So now you're at 320,000, you've got a return of 3.21, and you can easily pay for college and have probably $200,000 left over, which in 10 years is going to be worth another $320,000, right? So you've got this incredible savings device. And then if you think, okay, well, what would it look like when I'm 40? Well, if someone had done that, and you're today 40, you would have over $1 million in that money, right? In today's money would be many millions of dollars. In fact, let's figure out exactly how much it would be. It would be something like, and today, if someone had put 100,000 for you, you would have $2.6 million. And so on and so forth until, let's say, you wanted to retire at the age of 60, you would be retiring with 3.3 million. This is life-changing money. This is enough for you to retire comfortably and for everyone in your family to also be able to retire comfortably using the same strategy, and you've gone 32x in real terms on your money. But that's the S&P 500. What if we look at the NASDAQ, which tends to do 8%, just over 8%. It's 8.2, but we'll round it down. Maybe it's not going to perform as well in the future as in the past. Well, already you can see you've more than doubled your money after 10 years. By 20 years, by the time you're going into college, you're almost worth $500,000. By the time you're 40, you're worth over $2 million, and you are a deci-millionaire by the time you're ready to retire. Over 100x. Now, in crypto, we constantly are looking for 100x, but this is a guaranteed 100x. Pretty much guaranteed. It doesn't get much more guaranteed than this. And so there's a easy 100x guarantee out there for everyone. Okay, cool. This is great. Everyone can have access to this. This is why ETFs are so popular. Just buy the NASDAQ and forget about it. Do not trade. Scrounge up a little bit of money every month and put it into the NASDAQ, and your money will, over time, accumulate. All you need is a little bit of capital and a lot of patience. Patience is free. But now, let's look at Bitcoin, which has tended to do between 35% and 40% annualized over inflation. All right, well, now, after 10 years, someone had bought a Bitcoin, or if you buy a Bitcoin for your kid when they're born, by the time they're 10, they're already a multi-millionaire. By the time they're ready to go to college, they've got $40 million. And by the time they're ready to retire, they're worth billions. But this is not really going to happen, because Bitcoin isn't going to continue to appreciate every single year at 35%. Maybe that happens for the next 10 years, but probably not much beyond that. But it could easily decline to, let's say, 15%. And even at 15%, by the time you're ready to retire, you're up 4,300 times. You are worth $500 million. After 10 years, your 100,000 is 400,000. But I mean, here we say, over the next 10 years, you're probably going to make more than that, right? But even if you just look at this across long periods of time, the amount of money you're able to make with just a small amount of Bitcoin is phenomenal. In fact, let's say you were to buy a single Bitcoin for someone today, right? So let's say that's about $85,000. And then in the first period of 10 years, we are going to see, let's call it a little bit less returns than what we've seen up until now. So let's call it 1.3. And then we're down to 1.15 over the next 10-year period. And then let's say over the next 10-year period, we're down to 1.10. And then from there on, we're down to, let's call it, we're equal with the NASDAQ. Bitcoin is doing as well as the NASDAQ, even though it's been massively outperforming the NASDAQ. You can still see that the numbers... well, actually, I haven't built the spreadsheet to do this properly. But the numbers grow extremely large, extremely quickly. All right. So what has all of this got to do with MicroStrategy and Saylor and the way we should be thinking about our own capital? So the two new products that Michael Saylor is offering. One is called Strike, STRK, and one is called Strife, STRF. Let's talk about Strife. They're similar in many ways, and they're both targeted at the same audience, which is fixed income traders. So what are fixed income products? Fixed income products are not like the NASDAQ or like S&P 500. They always provide you a coupon, right? They always provide the same amount every single year, and they do not adjust for inflation. So the Strife, which is a fixed income product, which is going to be paid into perpetuity, what Strategy are promising is that they're going to pay 10% year over year, right? Now there's some other nuances to it. There are other ways in which you can benefit from Strife, but let's put them aside for a second because this all gets very, very complicated very, very quickly. Let's talk about that 10%. Who is that attractive to? That is attractive to people who want to make sure that they are earning a fixed income. And this is usually large funds like pensions, hedge funds, sovereign wealth funds, and corporates who do not want the volatility. They don't necessarily want the volatility of the stock market. They are willing to see the real returns diminish over time due to inflation, but not have the volatility. Usually, what they're able to earn is the current prevailing interest rate in the market, plus some bonus, some additional interest that they're able to earn because of the perceived risk of the product. But for a relatively low risk product, which isn't like a junk bond, 10%, which is what Strategy are suggesting, what they're proposing, is very, very high. And this market of the fixed income buyers, the fixed income market, that's a $300 trillion market. There's $300 trillion there looking for the best yields they can find. And so what Michael Saylor is saying is, I'm going to enter into this market. I'm going to try and drag out what he's saying is 1%. 1% of 300 trillion is 3 trillion, and put that 3 trillion into Bitcoin. And why do I want to do this? Well, basically what I'm saying is, I expect Bitcoin to appreciate year over year, on average, with volatility, but year over year on average by more than 10% for the foreseeable future, maybe forever, which is basically the length of time that you can continue to receive this coupon. And so what I'm going to do is I'm going to arb that difference. You, fixed income buyer, you cannot buy Bitcoin. You just don't have the mandate. Your fund does not allow you to buy it, but it does allow you to buy fixed income products. So I'm going to create a fixed income product, and I'm going to share with you the benefits of Bitcoin's appreciation, its price appreciation. So I'm going to give you every single year 10%. If there's a down year, I will absorb that. If there's an up year, I will take the additional upside. This is a really, really cool way for people who have different kinds of risk appetite to come to an agreement around how they're going to share out the potential upside and downside versus the volatility. Now, there's big risks in here. Strategy are basically promising to pay 10% every single year, but I think the bet that Saylor is making is that that 10% is fixed and inflation is going to eat it away. Right? They're putting in $100. He needs to give them $10 every single year. Inflation is going to mean that that $10 becomes less and less and less in real terms every single year. If that doesn't happen, or if Bitcoin has multiple down years and he's not able to sell Bitcoin, then the entire structure starts to become unstable. And so there's tail risk there. The other thing to recognize is that this almost guarantees that he is going to have to sell some portion of the BTC over the next few years on an ongoing basis. But it's going to be a relatively small portion. Basically, the bet that he's making, because the appreciation of BTC is so much higher than the payment that he is promising, is that not only will he only be selling a small portion of the BTC, the amount of BTC that he's going to have to sell is going to drop year after year after year. Somehow, he believes he's going to be able to bridge the gap when there are down years, which are inevitable. But perhaps the reason he's launching this now is because he can take in that capital now, expect Bitcoin's price to appreciate significantly over the next year, and then even if there is a down year, it's still going to put him, after all of that, even if it drops 70%, it will still be at a higher price point than the BTC that he's purchasing right now. And so how does this come back to us? The big message that everyone in this, Saylor, who's got his strategy, and the fixed income traders who have their strategy, and people who are investing in the NASDAQ, and people who are buying Bitcoin, the one thing that they all have in common is this understanding that only suckers keep their capital in cash because it dissolves. But more than that, not only is it dissolving, they are giving up basically guaranteed life-changing money by not investing it. And what keeps people on the sidelines is this idea that there are down years. There are so many options. Where do I put my money? It's paralysis by analysis, but really it's not even over-analysis, it's under-analysis, right? It's that fear that maybe at some point, maybe I'm coming in at the wrong time, or maybe I am, going to see red candles. It is that sort of trader mentality, that short-term mentality that keeps so many of us away from achieving life-changing outcomes. The reality is that getting rich is actually really easy. That is like the secret is not in complexity. The secret is in patience. The reality is that if you put your money in even something as simple as the NASDAQ, you are guaranteed significant, life-changing, phenomenal returns. Phenomenal. You are guaranteed to be a millionaire Now, it'll take 30 years, but you're guaranteed to be a millionaire. And the truth is, most of us are going to live a lot longer than 30 years. This is not a lot of time to wait, because you don't have to do any. You can continue to scroll through Twitter. You can continue to go to your job. You can continue to make love to your wife. And your money in the background just keeps chugging along, working for you. And if you are lucky enough to recognize an asset class which is significantly going to outperform, and not only are you guaranteed life-changing money, you are guaranteed sort of 1% type money over the same time frames, even billionaire type money. For you, for your entire bloodline. It's not hard. It just takes a little bit of capital and time. And we have that opportunity. We get to benefit from massively better returns than sort of the standard returns that people have had to put up with up until now. People talk about how good the boomers had it. I mean, boomers, they put their money into real estate. And real estate, across the last 100 years, has returned between 0.5 and 0.4 after inflation, right? So significant appreciation. When you look at people and you say, wow, these are people in their 40s and 50s and their house is worth over $1 million, and it was so cheap at the beginning. It was maybe an $85,000 house, and now it's worth 1.2 million. That was all done on the back of 1.05. Your generation, our generation, we've gotten access to this. Over the same time period, instead of buying a house, we would buy a Bitcoin, and we would see that go to 26 million or 108 million. And I know these numbers, they seem like a fantasy to everyone who's never experienced them, but they're absolutely real. In the same way that an $85,000 house turning into $1.2 million is absolutely real. We're very, very lucky to have this opportunity. And some of us are keeping our money in cash. So, my thought for you this morning, go and find all of that cash and put it somewhere, anywhere, and probably Bitcoin.